Where are you now going into year end as the rest of the pack on Wall Street talks about a step down and financial conditions start to ease?
Yeah, thanks so much, Jonathan, and thanks for having me on. For our base case, we still think that the Fed might end somewhat below 5% policy rates, but we would not be surprised by levels above 5%. I think anything up to 5.5% would not be too surprising at this point. And, it really goes back and kind of thinking all the way back in terms of why this Fed has been more hawkish and why we're getting higher policy rates. It's what you were just talking about it in the European context. We just have inflation data that continues to surprise to the upside, that continues to push policy rates higher.
How do you think the chairman navigates this conversation in the news conference, Andrew, this week, given that they don't have the forecast? There's no fresh SEP until December.
It's really difficult. In December, you do have a lot more variables that you can use to try to guide towards a step down in the pace of policy rate increase, but at the same time not trigger a loosening of financial conditions. And I think we saw a little of that last week as the market got excited about the fact that the Fed might be slowing the pace from a 75 basis point hike at this week's meeting to a 50 basis point hike in December. And we think that is what's going to happen. And that's not necessarily a dovish outcome. The hiking 50 basis points is still a larger than usual sized hike. The Fed could continue to hike at those larger sized hike sizes for an extended period of time, get to higher policy rates. So there's nothing inherently dovish about hiking at a slower pace. What the Fed needs to do is communicate that. And you're right, at the December meeting, there's a summary of economic projections that can show higher dots, suggesting that policy rates will move higher. It's really just going to come down to communication in the press conference at Wednesday's meeting. Can Powell talk about slowing down the pace, but still indicate resolve on fighting inflation?
What's more damaging for the economy, getting to 5% or 5.5% and then cutting perhaps 6 months later, or getting to 4.75% and holding it for 2 years straight?
I think what would be damaging for the economy, and I think to their credit, Fed officials have recognized this, is to allow inflation to persist at levels that are well above target. I mean, you were just talking and, we're kind of joking about the idea, could we get a 3%, 4%, 5% inflation target? But implicitly, that's what happens if the Fed continues to miss on their inflation mandate. If you continue to miss to the upside on inflation, then you embed in the economy a higher rate of inflation. And I think we're already seeing some of the costs, some of the uncertainty associated with not knowing how much wages, how much prices will be going up. That's the real risk for Fed officials. And that's why stopping too early is a risk and could imply actually hiking further at a later date. So you do have upside risk, you have downside risk. It's a complicated scenario. I think the primary risk right now is still the risk that inflation remains too high.
Andrew, you said something really important there, that by basically undershooting inflation again and again, they're basically communicating that inflation is going to remain higher than their target. This sort of speaks to what Diane Swank was talking about, their projections being fantasy land. How much do you think they've already done that by not really communicating some sort of downturn or something that is more realistic according to the economists' projections in terms of what kind of pain needs to happen in this economy to get inflation under control?
Yeah, I think it would be helpful if Fed officials concentrated a little bit more on the fact that labor markets likely need to loosen significantly to bring down inflation. It's a very unfortunate reality. It's a reality that nobody wants to be dealing with. But the empirical fact is that to bring inflation down from levels like the levels that we're seeing in the US and Europe, elsewhere, involves a significant loosening of the labor market. And that's almost a euphemism for saying the unemployment rate rises. Millions of people who currently have jobs no longer have jobs. That's a horrible outcome for the economy. That is the cost of inflation that's too high. And the issue now is minimizing the further cost of that. So I think that's right, Lisa. I think there should be more direct communication about the pain that's associated with bringing down inflation.
Andrew, I can sense even you're hesitating to say it out loud. And we do too around the programme, around the table on surveillance every single morning. And Andrew, I think they've still got to do a better job of communicating this. And it's not for me to do it for them. Andrew, how do they tell us that higher unemployment is a price worth paying to get inflation down? What's the answer to that?
Yeah, it's a very hard message to deliver, frankly. And I think that the answer is to be clear, be forthright, to talk about the historical evidence, talk about the theory. The theory that we have, when you look at the employment cost index last week, up 1.2% quarter on quarter. This is well above a pace of wage increase that would be consistent with 2% inflation. And so I think that's just one indication, a very tight labor market that's going to drive inflationary pressure. There's strong theoretical reasons, there's strong empirical reasons to think that that doesn't change without a loosening of the labor market. So I just think that we need to be clear and forthright about that. And to your point, Jonathan, it is an unfortunate reality. And I think that means that Fed officials and others have been reluctant to comment on it openly.
Andrew, we get unemployment data on Friday. We get the jobs report in America. Right now, I'm looking at payrolls. The survey, the median estimate about 190 from a previous 263. Andrew, can you tell me, as the year has progressed, have you sensed that perhaps this unemployment rate needs to go higher than you thought it did at the start of the year?
So I think there is a sense that maybe the unemployment rate doesn't need to go higher, but that the amount of restriction needed in the economy may need to be more to get to a higher unemployment rate. So we think that the unemployment rate may need to get to something around 5.5% to bring down inflation. That would be a lot higher than 3.5% where we are now. Historically, it wouldn't be as high as what we've seen in other recessions. So there is some good news there if you want to see it that way. I think that the issue is the labor market data continues to be very resilient. 190,000 new jobs in a month is going to be strong enough to continue to put downward pressure on the unemployment rate. So we have a tight labor market generating wage pressure that's too high. And that labor market looks like it may be tightening further. The only evidence to the contrary, job openings, the JOLTS job openings numbers, those have started to come down. We get a new reading on that this week. So I think that's going to be important. But overall, low initial jobless claims, there's just a lot of evidence that this is a labor market that has not slowed sufficiently to bring down that wage pressure.